This video series took 720 hours and 1 month to produce, truly enlightening. In this video, I will guide you through a breakdown of the essays of Warren Buffett delving into the investment mindset and philosophy of the legendary investor. This is more than just an investment book. It's a treasure trove of knowledge about success, finance, and mindset. If you aspire to shift from pursuing wealth to controlling wealth, this book will be key to achieving your goals. Hello everyone, welcome to today's video. In the previous chapter, we explored Buffett's investment philosophy and his long-term vision concept. Today, we will delve into Buffett's value investing principles, how he assesses the intrinsic value of companies and applies these principles to his investment decisions. Chapter 4, Market Sentiment and Investment Decisions. Market sentiment is a crucial factor that cannot be ignored in investment decisions. Investor emotional fluctuations, whether panic or overexcitement, have a profound impact on the stock market, even causing dramatic price swings. Understanding the influence of market sentiment on investment decisions and how to overcome the resulting emotional distress can help investors make more rational and long-term decisions. 1. The role of market sentiment. Market sentiment is generally defined as the state of collective investor sentiment, influenced by economic, political, and social factors, which in turn affect investor decisions. When market sentiment is positive, investors generally believe the economic outlook is bright, and the market has strong upward momentum. Conversely, when market sentiment is negative, investors tend to be pessimistic about the economic outlook, and stock prices may fall sharply. For example, during a bull market, investors often ignore potential risks and excessively pursue rising stock prices, while during a bear market, panic spreads and investors tend to sell stocks, further exacerbating downward pressure on the market. 2. The impact of panic. Panic is one of the most volatile forms of market sentiment, typically during market crashes or major economic events. Investors are prone to panic and rush to sell assets to minimize losses. Historically, many market crashes and financial crises have been closely related to panic behavior among investors. Panic not only affects the decisions of individual investors, but can also trigger widespread market sell-offs driven by this sentiment. Many investors often sell assets at the market's lowest point, missing subsequent rebound opportunities. Warren Buffett once emphasized, "The market is a voting machine in the short term, a weighing machine in the long term." He believes that short-term market fluctuations are unpredictable, but in the long run, the value of the stock market reflects the intrinsic value of companies. Therefore, adhering to the principles of value investing is particularly important during periods of widespread panic. 3. The impact of overexcitement. The opposite of panic is overexcitement. When the market is in an uptrend, investors are often driven by optimism, thus ignoring potential risks. Fueled by this sentiment, many investors begin to engage in excessive speculation, blindly chasing hot stocks, even buying when valuations are too high. This sentiment often leads to the formation of market bubbles. Many historical investment bubbles, such as the dot-com bubble and the real estate bubble, were formed under the influence of overexcitement. When these bubbles burst, investors often face huge losses. Therefore, rational thinking and taking appropriate risk control measures are crucial when the market is overexcited. For how to overcome the influence of market sentiment. A. Develop a clear investment plan. To overcome the interference of market sentiment, investors first need to develop a clear investment plan. The plan should include clear investment objectives, risk tolerance, and exit strategies. Regardless of market fluctuations, investors should adhere to their investment plans and avoid making emotional decisions due to short-term market volatility. B. Diversify investments to reduce risk. Diversification is an effective strategy for managing market sentiment fluctuations. By spreading investments across different asset classes and industries, investors can reduce the risk of losses from fluctuations in a single market. This way, even during periods of significant market volatility, the portfolio is less likely to suffer substantial losses. See a remain calm and avoid overreacting. Whether the market is rising or falling, investors should remain calm and avoid overreacting. They should not easily sell assets in the face of panic, nor should they blindly follow the crowd when the market is overly optimistic. Investors need to remain rational, focus on fundamental company analysis, and avoid being swayed by market sentiment. Need a long-term investment mindset. Warren Buffett's investment philosophy emphasizes the importance of long-term investing. He believes that investors should view stocks as part of a business, not just short-term speculative instruments. By holding companies with competitive advantages for the long term, investors can withstand market sentiment fluctuations and obtain consistent returns. Eat regular review and adjustment to avoid the influence of market sentiment on decision-making. Investors should regularly review their investment strategies and make appropriate adjustments based on market changes. Reviewing helps investors identify the emotional components in investment decisions and correct deviations in a timely manner. By continuously adjusting strategies, investors can better adapt to market changes and maintain the steady growth of their portfolios. 5. Conclusion: the impact of market sentiment on investment decisions should not be underestimated. If investors can understand the role of market sentiment and adopt effective strategies to overcome the impact of emotional fluctuations, they will be able to remain calm and make rational decisions in a complex market environment. Through the long-term philosophy of value investing, diversified investment strategies, and maintaining a calm mindset, investors can steadily move forward amidst market fluctuations and accumulate wealth. Remember, successful investing depends not only on market ups and downs, but also on investors' rational thinking and scientific decision-making. When facing market emotional fluctuations, only by adhering to one's own investment philosophy can true success be achieved in a complex market environment.